Hello and good afternoon. We are the Hickory Capital Advisors. We're excited to be here with you today in Austin and present our recommendations to the Renaissance Realty Advisory Committee. Introduction of our team. My name is Noah, and I'm joined by my friends and colleagues, Jackson, Zach, Jake, Alec, and Jensen. I'll provide a portfolio overview, and then we'll get into the market outlook, the fund's goals, our recommendations to the fund, and then the fund's performance based on those recommendations. Renaissance Realty is a $3.25 billion demographically driven and residentially focused fund with heavy exposure in traditional multifamily housing. The number one goal of this fund is to provide strong and consistent returns to its investors, and that is what has piloted our recommendations. The current LTV of the fund is right at 59% and has a 60% hard cap. The fund's target LTV is 50%. The fund's target IRR is between 9 and 11%, and right now it's underperforming. The fund has $50 million in redemption requests and no current commitments, but it's hopeful for the first half of 2025. I'll turn it over to Jackson for the market outlook.
Thank you, Noah. Now I'll go over the interest rate environment and show where the rates have been previously and where we think they're going looking forward. So this graph shows a great picture, and as everyone knows, the interest rates and inflation along with it have risen over the past few years. This blue line shows where the rates have started to decline, and in October, we saw a small uptick in inflation. That reflected around a 5% increase in the housing prices throughout 2024. Despite that uptick, with the downward trend of inflation, we think that justifies the Fed to reduce the rates by another 25 basis points in December. For our 2025 projection, we expect the Fed to reduce the frequency of the rate cuts to every other FOMC meeting, which will lead to the federal funds rate being a full percentage point lower than what it is today. Moving on to our residential market tailwinds, and again, it's very prevalent that there is an extreme housing shortage nationwide. We believe this is due to a demand imbalance. There is a high cost of ownership, and these elevated mortgage rates challenge the American dream of owning property, expanding, and it really feels unattainable at this point. This graph to the right shows the difference from 2019 to 2024 in the income required to own a home. It is up 97%. We believe that these tailwinds show how difficult it is to buy a home, but with the positive demographic trends that I'll get into in a little bit, and the fact that millennials and Gen Z are entering their prime rental years where they want to have more space and they want to expand, will really increase the demand in the rental sector. Moving on to our residential market headwinds, we've noticed a significant increase in supply in our key Sunbelt markets. There are high vacancies and a lot of rent concessions being offered. For our gateway, if you can tell, as you can see on the map to the right, the cities in the Sunbelt sector on the south, including Texas and Georgia, have a negative rent change in them multifamily apartments. For our gateway apartments in California and in the Northeast, and although these cities aren't listed on the map, there is a positive change in the rent growth. As I said earlier, and with the inflation rates to continue to decline, we expect the long-term mortgage rates to still stay above that 4% level and the cost of borrowing to remain high. Moving on to some demographic trends, I'll go over some migration patterns the U.S. is seeing. We are seeing a main trend is that a lot of people are moving to the Sunbelt region, specifically Charlotte and Greenville. Other cities in this region, including cities in Texas and Atlanta, have previously shown a lot of growth, but that was a few years ago, and now that high growth rate is lowered, it is deaccelerating and almost moderating. In our gateway apartments in the Northeast and in California, these dense coastal cities are experiencing a lot of domestic outmigration. That is offset almost completely by an influx of international immigration. I wanted to note that in Florida, specifically southern Florida, cities like Tampa and Miami are experiencing a large outflux of people, but in northern Florida, cities like Jacksonville are experiencing a lot of people coming in. A main trend we're seeing is that people are leaving these dense urban metros for ex-urban metros where they have an opportunity to expand, and which is why cities like Greenville are showing so much growth. Now I'll pass it off to Zach to go over some regulatory risks.
Thank you. There are a few current risks and a future outlook we must consider when evaluating our investment portfolio. For current risks, there remains rent ceilings in large coastal cities throughout the country, and high inflation and interest rates have made development more expensive recently. There also remains zoning restrictions in large cities. For the future outlook, we see a mix of some positives and some negatives on the horizon. Tariffs potentially being imposed by the new administration could increase material costs for renovations and development, but likely incoming tax cuts and potential incentives for future development to help bridge the gap between housing demand and supply could increase the profitability of all of our asset classes in our portfolio. We also see another positive of reduced environmental regulation for developers, given that the change in the EPA administration is coming in a couple months. There are some insurance risks in our portfolio in Florida and North Carolina. In line with historical trends, Florida remains the #1 most expensive state to insure in the whole country. And in North Carolina, there is a proposed 42% average home insurance rate increase due to a higher frequency of claims due to Hurricane Helene and the potential for future natural disasters in the state.
Based on the opinion of many industry leaders, this is where we currently see the multifamily real estate cycle at the end of the year 2024. Many of our key Sunbelt markets we see in a stage of oversupply, and our gateway apartment cities we see in early recovery stages or even recessionary stages towards the bottom of the real estate cycle. Now, looking ahead to our projections for the end of the year in 2025, we see not a lot of movement out of these coastal cities with a slower recovery and cap rates remaining high in these areas, where we see a much quicker recovery in our Sunbelt markets, where we expect to see lower cap rates and more favorable development conditions. Now, into our fund considerations. Hickory Capital's proposed plan is 4 steps. The first is to solidify the leverage position of the fund through strategic asset sales and debt paydowns. Given the high LTV that is currently almost at the hard cap of 60%, any decrease in valuations could put us over that threshold, which would make moving forward as a fund much more difficult, which is why this is of the utmost importance. Next is to diversify and rebalance the defensive positions in the fund into stronger performing sectors. Third is to position the fund to execute on any shifts we see in the real estate cycle. And lastly, it's to target growth opportunities in the build-to-rent sector in emerging Sunbelt markets, which we see as a primary strategy of the fund moving forward. Now into our subsector analysis. In our Sunbelt apartments, we're seeing a lot of oversupply issues that have led to occupancy being lower than expected and high rates of rent concessions. Because of this, we plan to decrease our exposure in these markets by 50% over the next year. While we do see the benefits of this market in the long term, which is why we plan to hold the remainder of the portfolio. In our Gateway City apartments in California, they're still experiencing lease up, and we'll monitor the income we generate there through stabilization. And in the Northeast, we're seeing strong cash flows and strong occupancy numbers. And given the high cap rates in the area, we plan to increase our exposure there. Now, for our student housing holdings, we see this as a recession-resilient asset that provides a good hedge against risks in the real estate cycle. And given the renovations that will lead to higher rents in the future, we plan on holding this as a significant part of our portfolio. Manufactured housing we also see as a key part of our portfolio moving forward, especially because of the low LTVs required to acquire these assets. It strengthens our balance sheet, which is why we plan to acquire more manufactured housing as well, which generates income immediately. And self-storage is another defensive income-generating asset that we plan to hold as a small percentage of our portfolio. Look at our build-to-rent sector. This is where we see the highest potential for growth in both return on cost and rent growth in the future. And while we see through our Texas and Georgia projects, we plan to expand our build-to-rent footprint in other smaller, faster-growing markets in the Sun Belt. And to tell you more about that strategy, here's Alec.
Yeah, thank you, Jake. As we know, there's a strong need for single housing in the United States. We've seen a massive housing shortage, and people are not being able to afford the American dream. I think this graph here represents this visually, and as you can see, in 2023, a roughly 3.9 million units of housing shortage throughout the United States. This is for many reasons, and what's interesting is that the largest disparity here, the largest regional housing shortage, is actually still in the southern markets, almost double that of in the Northeast and in the West Coast. We think this is a very good opportunity as a lot of people are reaching that age where they want to own a home in a country where it becomes increasingly difficult to own a single family home. Moving on to more specifics on the build-to-rent sector, this visual gives a great representation of some of the current top-performing BTR markets throughout the United States. You'll see cities like Phoenix, where build-to-rent was kind of pioneered, as well as Austin, Texas, Dallas, Fort Worth, Atlanta, Georgia, and now Charlotte, North Carolina, has really grown in their build-to-rent development moving forward. It is clear to us that the Sun Belt is the leader in BTR properties under construction, and it matches what Jackson was saying earlier with a lot of these demographic trends. People are moving south, they're moving from densely populated urban areas into more ex-urban cities that offer high growth in more space. As you can see, we believe strongly that as millennials begin to have children and seek home ownership, this is definitely one of the markets we wish to target moving forward. Now, breaking it down to a specific city standpoint, you'll see cities like Charlotte, North Carolina, Austin, Texas, Atlanta, Georgia, Houston, that have a massive amount of inventory currently on the buildup. So these are some of the same markets where many of you will have probably noticed a lot of oversupply and glut in the kind of multifamily housing developments. These are markets that had really strong growth post-pandemic, a lot of people moving there that has since slightly moderated. And with the gluttony of multifamily developments, rental growth has slowed in some of these markets. With build to rent specifically, we'll see annual declines in cities like Atlanta, Charlotte, and as we know, we have currently Atlanta in our portfolio with build to rent. So moving forward, we see this as an opportunity. We still want to target build to rent, but in markets of more an emerging stage of growth. Markets in the South and in the Southeast where people are still moving to, but they don't have that massive glut of supply as well as with multifamily housing. Moving to the next slide, one of these markets that we've identified and we are really excited about is Greenville, South Carolina. As you can see on the map, Greenville's positioned well. People are not only moving to Greenville from cities like New York City, but what's actually interesting is they're moving from other Sunbelt cities, as I mentioned, really dense urban populated areas like Atlanta, Georgia, Charlotte, North Carolina, into cities like Greenville. We are very excited about this South Carolina market. As you know, houses are not being built and it's become increasingly hard for developers. In South Carolina, we believe, has one of the more favorable regulatory environments. South Carolina was also the fastest growing state in 2023 with the largest influx of population moving into the state. And Greenville specifically was ranked number 4 as one of the best cities to live in the United States, notably above Charlotte, North Carolina. We believe Greenville is in the emerging stage of the build-to-rent market, and as we look forward in years like 2026 and 2027, we see this pent-up growth in build-to-rent as a major opportunity for the fund in some of these emerging Sunbelt markets. Think Greenville, Charleston, South Carolina, Virginia Beach area, and Raleigh, North Carolina. I'm now going to pass it off to Jensen, who's going to take you through the investment plan.
Thank you, Alec. So based off of our economic outlook, our market outlook, and the trends we've identified in residential real estate, here is our 2-year investment plan. Now this investment plan is twofold. First and foremost, to lower the overall fund LTV, and with that, decrease some of our annual debt service. Also, to move into an investment strategy that targets both acquisition of currently cash flowing properties, as well as more of this development build-to-rent strategy. First, I'd like to point out Q4 of 2024, where we plan to pay down 50% of the outstanding redemption requests, $25 million of cash on hand. Now, while we would like to immediately pay out all redemption requests, right now the fund believes that it's of the utmost importance to remain liquid and be able to pay off some of more expensive CapEx that we see coming in the initial year. Now, in the first half of 2025, we expect more inflows of investor capital. With this, we have 2 plans in the first half. First, to continue this acquisition strategy of manufactured housing, specifically in northern Florida. We like this because it's one of our less expensive strategies, as well as a very favorable debt and equity structure, being 80% equity, 20% debt, lowering again that overall LTV, and giving us some immediate cash flows with lower early initial CapEx. At the same time, we plan to begin the sell-off of our Sunbelt apartments, this being 50% of our North Carolina portfolio. With the proceeds from this sale, we'll immediately pay out the remainder of those redemption requests that we have outstanding, as well as pay down the accompanying debt and begin to lower the overall LTV of the fund. In the second half of 2025, you'll see another one of our acquisition strategies, this being another of the gateway city apartment acquisitions, specifically in the Northeast. With this, it's about a 50-50 debt to equity structure, so we'll be calling more investor capital to be deployed in another strong cash flowing investment strategy. Now moving to 2026, here in the first half of 2026, you'll see the rest of the sales of our Sunbelt apartments, this being 50% of our current Sunbelt Texas portfolio. With these proceeds, we'll really begin to pay down that debt and decrease that annual debt service as well, paying down the accompanying debt, a little bit more on the North Carolina holdings and the debt outstanding we have there, as well as our more expensive debt, our higher interest debt on our build-to-rents in both Dallas and in Georgia. And lastly, you'll see the beginning of the development strategy that we have, a 50-50 structure of build-to-rent specifically in Greenville, South Carolina. This will spearhead our new strategy as we move into this development phase and really look to identify these emerging markets in the Sun Belt. Now, I'd like to point out that while we don't plan to call an inordinate amount of capital over the next 2 years compared to recent years, we would like to prepare investors for potential additional capital calls as the fund would like to stay agile and poised to execute on these trends that we find, such as this build-to-rent in these high-growth Sun Belt markets. Now, lastly, I'll conclude with explaining how our proposed portfolios will change the overall fund performance. First and foremost, you can see our cash flows here in the graph on the left. And in 2027, we really expect, with the completion of our current build-to-rent portfolios that we have, as well as the finish of some lease-up and the completion of the acquisition of the immediate cash flowing assets, we'll really see the proposed portfolio begin to surpass the projected cash flows of the as-is portfolio and grow at an exceeding rate into the future. Now, over on the right, you can see the IRRs, the levered IRRs of each subsector. And you'll really realize why we're so excited about build-to-rent, offering a 17.5% levered IRR back into the fund, far surpassing any of the other subsectors. Now, I'd like to point out that both of these charts assume a 5-year investment horizon, as well as base case scenarios. Now, to speak more to the base case scenarios, I'll point your attention to the table up on the top right. We know that interest rates, as well as inflation rates, have long been a concern, both of our investor committee and of ourselves. So we did a bit of a scenario sensitivity analysis of our both proposed fund and as-is fund. In the inflation scenario, we assumed extreme inflationary environments, increasing our assumptions on OPEX as a percent of gross income by 10%, CAPEX as a percent of NOI by 5%, while only increasing our assumption to rent growth by 1%. And then with the interest rate, the worst case scenario, we assume 50 basis point increase in each period to what we have it pegged at as our base case. And as you can see, in each mix of scenarios, the proposed portfolio's net levered IRR surpasses the as-is IRR by 20 to 50 basis points. Lastly, I'd like to point out the debt service. Here you can see that the strategy of paying down these higher LTV properties and removing some of them from our portfolio gives immediate cash flow back into the fund. With a lower debt service beginning in 2026, we can really begin to realize some of these cash flows, passing that back to investors, as well as be able to take advantage of these lower interest rates, refinancing out into the future. And again, begin to call these cash flows back into the fund, allowing us to remain more liquid and move those investments back to the investors, as well as into new strategies. So now I'll pass it back to Noah to wrap us up.
Thank you, Jensen. Based on Hickory Capital's recommendations, Renaissance Realty is able to achieve its goals: decrease its LTV to 51%, increase its net IRR to nearly 10%, and become strategically positioned to execute on emerging trends such as the build-to-rent properties. With Hickory Capital's recommendations, Renaissance Realty will achieve much more of its number one goal: to earn strong returns and consistent returns to its investors. Thank you.